Hi class, this is now a continuation of the Chapter 3 discussion. I'm going to pick up where we left off, and we're going to jump into some transactions and see how we can apply that using not only our debit and credit rules, but also we want to learn how to journalize these transactions. So here we're looking at transaction number 1. It says on January 20th, 2021, the McBride family invested $80,000 in exchange for capital stock. Thus, the asset cash increased by $80,000, and the owner's equity account capital stock increased by the same amount. So, let's first look at what we did in Chapter 2 using the accounting equation, because we're all still using that. So, assets equals liabilities plus owner's equity. So here, the family invested $80,000 in exchange for in exchange for capital stock. So there's two things involved here, right? We have cash, the cash account, and the capital stock account that's involved. Okay, so assets are going up, right? Assets are going up in the amount of $80,000, but specifically it's the cash account that's going up by $80,000. And then how do we balance that? Well, it balances out with the other side under owner's equity, right? Owner's equity is also going up by $80,000, but specifically it's capital stock, that account that's increasing in the amount of $80,000. Now, let's look at this part we've done so far. Exactly just this is what we did in Chapter 2. Now let's build upon that. Remember in the previous video, we saw how we can represent these accounts that we've been talking about by using these T accounts. So we can show what's happening here by drawing out the cash T account and then the capital stock T account as well. So let's recall, when assets go up, how do we represent an increase to an asset? That's done with a debit, right? A decrease to an asset is done with a credit. Remember, debit is on the left, credit is on the right. And if you haven't already, in the Chapter 3 module, I included a very interesting debit-credit song. It's kind of like a rap song or whatever it is. It's very, very effective. Watch it once or twice, and you'll thank me. And then you won't have to try and remember what side the debit is on and what side credit is on. So here, cash is going up. Right? Cash is an asset. How do assets go up? With debits. So we have to show that increase of cash of $80,000 by putting a debit to cash here on the left-hand side. But debits need to equal my credit, so if I debit something here, I need to credit something somewhere else, and that somewhere else is capital stock. How do you represent an increase to an owner's equity account? Increases are shown with credits, and decreases are shown with debits. Credit is still on the right side, debit is still on the left side. So since capital stock is going up, we need to show that on the credit or right side by crediting capital stock in the amount of $80,000. Okay, so that's how we've gone from drawing this out using the accounting equation, but now what we've done here is post it to the T accounts or the ledger accounts specifically. But really, that comes after you actually journalize it. I actually have to show you guys how we would journalize this in the journal, because the journal is where we actually record these transactions first, and then they're posted to these T accounts. So, in terms of journal entries, there are some rules we need to follow. So, what you see on the left here, that's a general setup of a journal entry. So some rules we have to follow is you always do your debits first. Whatever account is being debited is listed first, and then you list the credits. Okay? Now, for example, we want to look at what we know to have happened here. So cash, we said cash is going up in the amount of $80,000. So to journalize this, you write cash, and then you write $80,000. There's really an imaginary, I'll write this with a thinner one, there's really an imaginary T account here technically, we don't write that T, but there's the debit side, and then there's the credit side. So remember, we debited cash for $80,000 because we increase assets with a debit, but then capital stock is being credited. Every account that you credit, keep in mind, you have to indent. That indicates that this is the account that I'm crediting. You indent once you are crediting an account, and that goes on the other side. And see, this reflects on what the T accounts look like, right? We debited cash on the left, just like in the T account, and credited capital stock on the right. And usually, you'll always want to date these journal entries. I'm not going to do all the dates here just because we're working through this, but in the PowerPoint here, you can see all the details. It's dated. There's an explanation. Owner invests cash in the business of what's happening there. And then we can see this is happening all in the general journal. But keep in mind, this imaginary T account isn't drawn usually for us. But sometimes you'll see, debit and credit sign listed up above. That's my debit column, that's my credit column. So this is how you journalize that transaction. Well, first of all, this is how we write it in the accounting equation. This is how we journalize it. And then this right here is how we post it to the T accounts. You journalize first in actual practice. You journalize first, and then you post to the T accounts. All right. And again, just posting just means when we actually write out the entries in the T accounts. So just keep that in mind. This is journalizing. This is posting. And I'm not going to go through all of these slides here. I'm really just wanting to go through the transactions. So you can go through and look at all those details. But this is really just explaining in detail what we just did there. So let's look at this next transaction. It says that representing overnight, McBrien negotiated with both the City of Santa Teresa and Metropolitan Transit Authority to purchase an abandoned bus garage. On January 21st, Overnight Auto Service purchased the land from the city for $52,000 cash. Again, let's write out the accounting equation. And as you practice this more and more, you won't need to write out the accounting equation, but it's really helpful as we start learning this for Chapter 3. So let's first start with what we know. The Overnight Auto bought land for cash. So there's a couple of things happening here. I know there's a land account that's involved. There must be a cash account that's involved. What's happening to your land account now that you bought land? Land must be going up. What's happening to your cash account now that you use that cash to buy land? Cash must be going down. So let's illustrate that under the accounting equation here. There's an increase of $52,000, specifically due to land. There's a decrease of $52,000 due to cash being used to buy that land. Nothing else is happening on the other side of the equation, but we cancel out here on the left. Okay, so we have an increase and a decrease here to assets. Increases to assets are shown with debits. Decreases to assets are shown with credits. So although we post really later in the process, I just like T accounts for illustrative purposes. We have our land account. Remember, the title goes at the top. And then we have our cash account. Land, we said, is going up, right? So does land need to be debited or credited? It needs to be debited in the amount of $52,000. Cash is going down, though, in the amount of $52,000, so it needs to be credited for $52,000. In order to journalize in journal entry form, we do the same thing. Which is being debited here, land or cash? The land account's being debited. Remember, debits before credits. So I list land first, and I debit it for $52,000. And then since cash is being credited, I indent a little bit, write cash, and then credit that account for $52,000. So this is really what you do first, and then you post to the T accounts. And again, to help us visualize this, there's really an imaginary T account here. That's why we do it as we do it. This is the debit side, and this is the credit side. Okay? And the nice thing about these slides is they kind of put it all together for you. So it's really nice for reviewing. Okay, next entry. Let's scroll down here. Overnight completed the acquisition of its business location by purchasing the abandoned building from the MTA. The purchase price was $36,000. Overnight made a $6,000 cash down payment and issued a 90-day non-interest-bearing note payable for the remaining $30,000. All right, so let's see what's happening here. Bought a building. Purchase price was $36,000. So it's safe to say that the building account's going up by $36,000, right? You just bought a building. But how did you pay for that building? Well, we purchased part of it in cash. So our cash account is going down by $6,000. And then also we had to borrow the rest, right? We're financing the rest. And they tell us it's in the form of a note payable, which is a liability. So the note payable is $30,000, and that's going up, right? Because you owe more money now. Let's illustrate that under the accounting equation. We have two assets involved here. We have an increase to assets of $36,000 due to the building account, but then we also have a decrease of $6,000 due to the cash account. So overall, we can see there's an increase of $30,000 to assets here. And liabilities is going up by $30,000 due to the note payable account. So let's journalize this. So you have the building account. It's going up by $36,000. It's an asset. Assets are increased with debits. What's happening to cash? Cash is going down by $6,000. Cash, or any asset, is decreased with a credit. And then lastly, our note payable, that one's going up by $30,000. And since it's a liability, how do liabilities increase? They also increase with a credit like owner's equity does. So let's journalize that. Debits before credits, remember? So what's the thing or things being debited? Building. So you write building first. Move over a little bit to the right, and you put 36 to debit the building account for $36,000. Then everything else is being credited. There's no other debits here. So you go down a line, but remember you indent for anything being credited. I indent and write cash, and I move over, make sure it's on the right-hand side of that 36, and I credit cash for $6,000. And then I put note payable down below as well. It's also indented because it's being credited. And put it under the $6,000 because that's the credit column. I'm crediting or increasing notes payable by $30,000 here. And that is how I journalize the purchase of a building for part cash and part of it being financed. So this is the journal entry, and this is how we would post that to our ledger accounts. We said you just look at what's happening in the journal entry. You just copy it over here. We debited the building account, which is on the left-hand side, so you debit the T account for $36,000. Same with the cash account. You credited cash on the right-hand side under the credit column. We do the same with our notes payable T account. It's being credited, so you credit it over here as well. Okay, so we're just copying over what just happened up there down into these T accounts. All right, next one. Overnight purchased tools and equipment on account from Snappy Tools. The purchase price was $13,800, due in 60 days. So if it's due within 60 days and there's no mention of interest, we can assume it's in accounts payable. So we bought tools and equipment for $13,500, and they bought it on account, right? So we didn't pay for it in cash. So instead, we're going to use the account called accounts payable, which means we owe someone money. So the tools and equipment account, it increased by $13,000. Oh, sorry, not $13,500. It's $13,800. It increased by $13,800, and so does the accounts payable because I didn't pay for it in cash. And we can write that out using the accounting equation. Tools and equipment, that's an asset, right? So assets are going up by $13,800. Accounts payable, what kind of account is that? Liability or owner's equity? It's a liability. So that goes up by $13,800 as well, and we are in balance. Assets are going up and liabilities are going up. But how do assets increase? They increase with a debit. Liabilities increase with a credit. So I'm going to have to debit something under assets, and I'm going to have to credit something under liabilities. So what's the asset going up? It's tools and equipment. So when I journalize this, the first one I write is tools and equipment, because debits before credits. I debit tools and equipment for $13,800. And there's only one other account involved. It's the accounts payable, and it's being credited for $13,800. Remember, the thing you credit, you skip a line and you indent. And now I can write out accounts payable. And that's for $13,800. So now that we've journalized it, we can post it to our ledger accounts. Our tools and equipment account and our accounts payable account. And we just copy it over. You just look at what's happening here, because remember, this is like that invisible little T account, just by virtue of how journal entries are designed, right? Debits and credits. So tools and equipment we can see is being debited by putting the number on the left-hand side. So I have to debit the tools and equipment T account for $13,800, and then I have to credit accounts payable for $13,800 on the right. And we are in balance because my debits equal my credits. Okay, on to the next one here. Overnight found that it had purchased more tools than it needed. On January 24th, it sold the excess tools on account to Ace Towing at a price of $1,800. The tools were sold at a price equal to their cost, so there was no gain or loss on the transaction. So there are a couple things that are happening here. So we sold some of the tools to another company. Okay. And it doesn't say we sold it for cash, so we can assume there's an accounts payable involved. So if I sold some of my tools and my equipment, is that going up or down? Tools and equipment must be going down, right? If I sold $1,800 of it, sold some of it, but I'm not getting cash. There's no increase in cash yet, right? Because they didn't pay for it in cash. I'm waiting for my money. So what's the next best thing to cash? It's that account called accounts receivable, right? That's the account that refers to money that other people owes me. Other people owe me. So that's an increase to accounts receivable because that's money that's coming to me. And let's illustrate this under the accounting equation. Assets are going down by $1,800, right? Because I just sold some tools. But at the same time, assets are also going up by $1,800, right? Because accounts receivable is also an asset. It's the next best thing to cash. It's listed right below cash on the balance sheet. So tools and equipment being an asset account, it's being decreased. So I'm going to decrease that with a credit. Accounts receivable is being increased. It's also an asset, but remember assets go up with a debit. So which one are we going to list first when we journalize it? Accounts receivable, because it's being debited. Always debits before credits. So I write out accounts receivable, debit that account for $1,800, I'm going to credit my tools and equipment account. Remember, skip a line, indent a little bit, and then because it's being credited, I need to put that number in the right-hand column. And there's my journal entry for that transaction. But then it needs to be posted to the ledger as well. I have accounts receivable, and I have my tools and equipment account. Accounts receivable, again, just copy what's being done here, because really the journal entry is a T account in disguise, just with explanations there. Accounts receivable is being debited for $1,800, so I put that number on the left. Tools and equipment being credited, so I put that number on the right-hand side there. Remember, debit side, credit side. Okay, next one. Overnight received $600 in partial collection of the accounts receivable from Ace Towing. So remember, just now we sold those some of those tools to Ace Towing, and they owe me $1,800, right? I'm waiting for that $1,800 to come to me. But they didn't pay me right away. But now, on January 26th, what's happening is they're paying off part of that $1,800 that they owe me, so they're paying me $600 now. So let's see what that would look like. If you're getting paid $600, cash is going up, right, in the amount of $600. But now that cash is going up, they owe you less money, right? Because they just paid you some of what they owe you, so they owe you less money. So I have to decrease my accounts receivable to show that, okay, they owe me less money now. They don't owe me $1,800 anymore. They only owe me $1,200. So let's draw this under the accounting equation. Assets, cash, right, is an asset. It's going up, so assets are going up by $600. But accounts receivable is also an asset. It's the next best thing to cash. That's going down by $600. So there's a net effect of 0 here under assets. So cash is going up. Cash is an asset. Assets are increased with debits. Accounts receivable is going down. Accounts receivable is an asset, so it needs to be decreased with a credit. So what's being debited here? Cash. So it needs to be listed first. Remember, debits before credits. Write cash, skip a little bit over, and write the 600. Go one line down, indent, because now there's no debits left. There's just credits left. I need to credit my accounts receivable account. So to credit it, I move over and write it in that right-hand credit column. And as a reminder, to help visualize that, there's that imaginary little T account there. And now we can post that to our ledger accounts. There's the cash T account, and then there's the accounts receivable T account. Cash is being debited on the left, and accounts receivable is being credited on the right. But one interesting thing to note here is, remember, based on the prior entry, how much you had a balance in accounts receivable, right? We debited accounts receivable for $1,800, so initially it had a balance of $1,800. But now I'm coming over here and I'm crediting accounts receivable for $600 now. How much do I have left? Remember, to find the balance in an account, I simply subtract my debits and my credits. Which side is heavier? Looks like it's the debit side. So what's $1,800 minus $600? It's $1,200, so that means I have a $1,200 debit balance, since it's on the left, of accounts receivable. So if I want to write out the accounts receivable T account now in summarized form, I would show it as follows. It has a debit balance of $1,200. Okay. Next one. Overnight paid or made a $6,800 partial payment of its accounts payable to Snappy Tools. So remember, they bought those tools from Snappy Tools originally on account. Now they're paying off part of what they owe them. Remember, accounts payable refers to what I owe someone else. So you made a partial payment. So you're making that payment in cash. No other way, right? So if I'm making that payment, that means cash is going down by $6,800. Well, while cash is going down, What am I using that cash for? To pay off part of a debt. So what's happening to accounts payable? If you pay part of what you owe, then your accounts payable should also decrease. Since you're paying off part of a debt, your liabilities should go down. Assets equals liabilities plus owner's equity. There's an increase under assets of $6,800 here. And sorry, that's not an increase. That is a decrease to cash. We just wrote it up there. So a decrease to cash of $6,800, which is a decrease to assets. So while assets are going down by $6,800, so are liabilities, and there's a decrease to liabilities of $6,800. And remember, if we want to, the best practice of showing these minuses is actually by showing it in parentheses, just as a reminder. All right. So we want to journalize this. So assets are going down, liabilities are going down. So when assets go down by $6,800, is that a debit or a credit if assets are going down? It's a credit. And if liabilities are going down, do I do that with a debit or a credit? I do that with a debit. So when we want to journalize this, we look at what's being debited first, right? That gets written out first. So liabilities, which one in particular is going down? Accounts payable. So I write that one out first because it's the one being debited. So I'm going to write out accounts payable. Debit that account for $6,800 to show that it's going down, and then I skip a line, indent, and write cash, and show that I'm crediting cash for $6,800 in the right-hand column there. And again, there's our little T account to help us visualize that. Okay, and now since we've journalized it, we want to go ahead and post it to our ledger. So this happens in the general journal. Now I'm posting it to the ledger. So we have the cash account, and then we have accounts payable. Cash is being credited, right? So it gets shown on the right-hand side. And then accounts payable is being debited with $6,800 on the left. And keep in mind, as you can see on the slide here, we're keeping track of all the debits and credits in that T account as we go along. So, for example, if the next day I debit cash for $10,000 and then credit it for $2,000, what's my balance? How would we figure that out? Okay, well, we start with the $6,800, right? And we add the 10, and that $6,800 is actually minus. You have to actually assume a beginning balance. So let me write out let's ignore that one for a second just because I don't want to get you guys confused with that cash T account on the right. Let's just assume a new cash account. Let's assume that I debit the cash account for $10,000. Then I credit it for $2,000, debit it again for $3,000, and then credit it for $1,000. Remember, cash accounts are asset accounts. And asset accounts normally have a debit balance. So let's figure out how we would figure out the balance in the cash account. Remember, it's the combination of your debits and credits. So we take that $10,000. So initially I had $10,000 in the cash account because I debited it. But then we credited the cash account. Remember, that's a decrease when you credit cash. And there was a debit for $3,000. And then yet again another credit of $1,000. So looks like I have a balance there of $10,000. I'm not sure if that looks right. We did 10,000 minus 2 plus 3 minus 1,000. That looks about right. All right. So that's a positive 10,000. That means I have a $10,000 cash balance, but it's a debit balance. So we would write that balance here on the left-hand side. And how else could you figure out where the balance needs to be written? Well, how much do you have on the left? I have 13,000 on the left. How much do you have on the right? 3,000. So which side is heavier? The 13,000 is heavier. So we do 13 minus the 3 gives us the 10. All right. But for purposes of writing these transactions, I'm not keeping track of the T accounts, the slides do that because I just want to make sure we know how to post these. All right. And it's a little bit small here, so you can look on your own time at the slide, but this is just looking at all those T accounts and the debits and credits throughout all those transactions in summarized form. All right, so what is net income? So net income is not an asset, it's not cash. It's simply an increase in owner's equity from profits of the business. This is something we talked about in class, okay? Net income is one of those things that increases owner's equity. The presence of net income increases owner's equity. And remember we talked about its components, right? Revenues increase net income. So if revenues increase net income, revenues also increase owner's equity. Expenses, however, they decrease net income. So if expenses decrease net income, expenses decrease owner's equity. Okay, so that's an important note to make when we learn the debit and credit rules for those two items. So you want to go back to what revenue does to owner's equity and what expenses does to owner's equity to understand why their debit and credit rules are what they are. Okay, so remember retained earnings is one of our owner's equity accounts. Okay, it's part of owner's equity like capital stock is. So when we say net income increases owner's equity, or revenue increases owner's equity, or expenses decreases owner's equity, we're really just talking about retained earnings. When we say net income increases owner's equity, we're saying it increases retained earnings, because remember, retained earnings is just part of owner's equity. So net income increases retained earnings, but so does revenue, and expenses decreases retained earnings. Remember, retained earnings is just the accumulation of profits in the business minus any dividends. Okay? Now, there's another thing that decreases retained earnings, like expenses does, and that is dividends. If dividends are declared, that also decreases retained earnings, because remember, that's a payment to an owner or to owners. So dividends are one of those things that decrease owner's equity just like expenses do. So these two are a bundle and those two are a bundle. Okay? And this is just a reminder of what an income statement looks like, and this is specific to overnight auto service based on all those transactions. We have two kinds of revenue here for them. They have repair service revenue and rent revenue earned, and they have all these expenses listed here. Now, usually with the income statement, it's broken up down below. First, with income before taxes, that's simply your revenue minus your expenses. Then you list your income taxes, because this income before income taxes number is what you use to calculate your taxes. So you can't know what your income taxes are until you know what your income before taxes is. And another name for income before taxes is taxable income. So it's only until you actually list your income tax expense that you can find your net income figure overall. All right, and here's just some important terminology that we need to make sure we go over. So accounting period, that's just the period of time that covers an income statement. So a company can choose to have the income statement cover a month, 3 months, 6 months, a year, just depends. The time period principle says that net income is measured usually for relatively short accounting periods of equal length, so that it's easier to interpret those financial statements and easier to prepare them, as opposed to it being haywire in terms of always using different times and different stretches of time to cover those income statements. In a fiscal year, that's just a 12-month accounting period that companies use. So a fiscal year is just a 12-month accounting period that a company chooses. So a fiscal year won't necessarily always line up with a calendar year, which is January to the end of December. A company's fiscal year might not start on January 1st. It might start on a different time of the year, but it's still 12 months. All right, so let's get into our discussion of revenues and expenses and so on and so forth. So the realization principle is an important principle that we'll get to in a second regarding revenue, but let's first take a look. So revenue is the price of goods sold and services rendered during an accounting period. So the key there is goods sold and services rendered. In order for revenue to be considered revenue, goods have to be sold, right? And services or services rendered. Now, there's some specific legal things on when something is deemed sold. Technically, when ownership is transferred, we're not going to really get too deep into that. But just in general, so you know, revenue occurs if you sell something or if you render a service. Okay? Like we said, it increases retained earnings. So it also increases owner's equity by default. Okay? And either it's going to cause an increase to cash when you earn that revenue or an increase to accounts receivable. Because is it possible to sell something to someone or to render a service and then not pay you right away? Of course, companies do that all the time. But just because someone doesn't pay you right away doesn't mean you don't record the revenue. You ask yourself, has the revenue been earned? Did I sell a good? Did I render the service? If the answer is yes, then I have to record it. Either I got the cash right away, or I didn't, which would involve an accounts receivable. But if you did not earn it, if you didn't sell a good, or you didn't render a service, then you did not earn the revenue yet. So someone promising to buy something from you tomorrow does not constitute as revenue. Only when you make the sale does it constitute revenue. Okay? And revenue, the generation of revenue is the overall goal for a business, right? To generate revenue so that you can hopefully be operating at a profit. So this realization principle is very important. So this is the rule that governs when and how we should recognize revenue as earned or not. So this principle basically says that you should recognize revenue as earned, like we said a couple of moments ago, when goods are sold or services are. And also, we need to be able to measure the sales value objectively. It's not like we can say, oh, I think I sold it for this much or anything like that. That wouldn't suffice. I need to know, okay, this is how much I sold that product for. This is how much I performed that service for, right? As long as I can identify those numbers and goods were sold and or services rendered, then I can record that revenue as earned. All right, on to expenses. So expenses, it's basically the cost of goods and services that we use up in order to make that thing called revenue. Because we need to, in order to generate revenue, to make money, we need to spend money to some extent. So expenses are the costs of the goods and services used up in the process of earning revenue. So it's the costs, the key word here, costs used up in a given period to generate revenue. So examples would be like salaries expense, advertising, rent, utilities, depreciation, okay? And you have to spend money to make money, right? It sounds cliche, but it's you can't not pay your employees. Some companies really need the advertising. You can't not pay your rent, right? Now, what do expenses do to retain earnings? Well, if revenue makes retained earnings go up, expenses, remember, makes retained earnings go down, which is part of owner's equity, so it also makes owner's equity go down. Okay? So the recording of an expense will result in either a decrease in an asset or an increase in liability. So in other words, how do you pay for rent or utilities or salaries? Either you pay in cash right away, which would decrease cash, which is that decrease to assets, or you pay for it later, which would cause an increase to accounts payable, which is a liability. All right, so that is the overall overview for expenses versus revenues. And how are they connected? So we have the matching principle, a very important foundational principle, not only for this chapter, but for the entire class. So this is where this is the principle or concept that refers to offsetting expenses against the revenue that it helped to generate. So we want to match these expenses with the revenues that it helped to create, because we spend this money on expenses to produce revenue, to generate revenue. Okay, so to measure net income for a period, if we say, hey, we earned this revenue for the period, then you have to show the expenses that were incurred to help make that revenue in that same period. Okay, so that's the matching principle. But sometimes, though, we spend money on things that don't just benefit one period, but they benefit multiple accounting periods. So salaries expense used up, for example, all in that same period. But what about things like a one-year insurance policy? What about that? Or a building? Remember, if you buy a building, what did we say about that? You're not going to use the building up all in that same accounting period, so it's not an expense. This would be regarded as the purchase of an asset. But what about the one-year insurance policy? How is that insurance policy just going to benefit me in that period in which that month that I buy it? No, it's going to last for 12 months, right? It's going to benefit more than one accounting period, and it's supporting my revenue generation. So this insurance policy, I'm not using it up right away. I'm using it up over time. So this insurance policy wouldn't be expensed right away, and we'll learn more about this in Chapter 4, but instead, when I buy that insurance policy on that day that I record the transaction, it would actually be recorded as prepaid insurance, which is an asset account. And only when I use up some of that insurance does that asset get converted partially into an expense, and we'll look at that in Chapter 4. Okay? And then what we'll learn also later about is when it comes to a building or equipment, although that's a purchase of an asset, so it's going to go on the books as a building, but there are some long-term assets like buildings that we have to depreciate. And depreciation is regarded as an expense that goes on the income statement as well. And there's a whole chapter dedicated to depreciation and different depreciation methods, but in Chapter 4 we'll learn how to journalize for that, using our first method, which is the straight line method. Okay, so one of the things is you want to be able to at least, like for a building, estimate how many accounting periods it might benefit. In other words, how many years we think that building will be able to be used to help generate revenue. So I could make a fair estimate and say, okay, about 20 years, my best guess. But there's really no way of knowing. So using your best judgment, best professional judgment, accountants kind of just decide on what the best estimate is for the useful life of an asset, or how long an asset is going to benefit the company, for how many accounting periods. But usually if you're unsure, it's always encouraged to err on the side of conservatism, be more conservative rather than being too crazy with the numbers. So that's, if you can't really make a really informed estimate, be as conservative as possible. All right, and for our class, and just public accounting in general, the focus is on accrual accounting, the accrual basis of accounting. And it is, or it depends on, so accrual accounting depends on the realization principle, and the matching principle, like we mentioned before. So that means revenue is recognized in the period that it is earned, whether or not I receive that cash right away, and expenses are recognized in the period in which they are incurred, whether or not I pay for that expense now or later. So that's accrual accounting. We're using these two methods to dictate when we journalize and how we journalize certain things. This is different than the cash basis of accounting, which a lot of us might be familiar with. This is like the mom and pop shop, most likely. The smaller businesses often use cash basis of accounting, where it's just cash in and cash out. So when cash is collected, revenue is recorded. When payments are made, expenses are recorded. So there's no attention paid to when that revenue was actually earned. You just record the revenue when the cash is collected, not necessarily when you earn it. And although I might have gotten the bill last month, under the cash basis of accounting, I don't record the expense until I pay it under cash basis of accounting. So it's really just cash in and cash out. So this doesn't give us such a good picture of how profitable the company was during a period, because you're mixing time periods, because that revenue could have been earned 3 months ago and now I'm getting the cash today. So it makes it look like you're profitable now when that is actually coming from 3 months ago. So although this is often more practical for smaller businesses to use because it's easier, accrual basis of accounting is a lot better in terms of giving you a measure of profitability, liquidity, and just keeping things really nice and organized. So what about the debit and credit rules then for revenues and expenses? Because those are also accounts. Revenues and expenses have accounts just like assets, liabilities, and owner's equity. So we want to go back to what revenues and expenses do to owner's equity. Revenues, they increase retained earnings, which means it increases owner's equity. How do we increase owner's equity? Recall how we increase owner's equity. Remember, that is done with a credit. So because revenues increase owner's equity, we increase revenues with a credit. So when revenues go up, you show that with a credit. When revenues go down, or you have to show that with a debit. But when you're talking about revenues going down, if we have to journalize that, that just often would be if we're actually fixing a mistake. So this right here is what most of the time what we'd be focusing on. But what about expenses? Expenses decrease retained earnings, which in turn decreases owner's equity. And how do we decrease owner's equity? With a debit. That means expenses are always increased with debits. Expenses are always debits. So when expenses go up, we show that with a debit. Okay, and the opposite would be with a credit. And then what about dividends? Dividends do the same thing that expenses do. Dividends also decrease retained earnings, which means it decreases owner's equity. And we decrease owner's equity with a debit. So dividends, because it's payments out to owners when they go up, we show that with a debit. And the opposite would be shown with a credit. Okay? And there's that summary of owner's equity increases and decreases that we just talked about. Dividends. Remember, that's a payment to owners, right? Payment of usually cash to owners. So when we pay a dividend, not only does it decrease assets, but it also decrease owner's equity. But let me be clear, dividends are not expenses. They have the same effect on retained earnings that expenses do, but they are not expenses. Okay, so now based on the little bit extra that we learned now on the debit and credit rules, we are going to look at this last set of transactions and work through those. All right, so on January 31st, they recorded revenue of $2,200, all of which was received in cash, so all in cash. So if we want to, we can write this under the accounting equation, although revenue is not a balance sheet account, but it affects the balance sheet, right? Because it affects owner's equity. So we receive that revenue all in cash. Cash is an asset, so cash is going up by $2,200. Revenue is going up by $2,200. Revenue increases retained earnings, which increases owner's equity, so there's an increase to owner's equity inadvertently or indirectly, which we'll learn about more in chapters 4 and 5. So revenue is going up by $2,200. Revenue, how do you record increases to revenue? Remember we said revenue increases retained earnings, which increases owner's equity. And how do you increase retained earnings and owner's equity? With a credit. At the same time, we receive that revenue in cash, so cash is going up by $2,200. Cash increases assets, right? Assets go up with a debit. Which one's the debit? Cash is. So we list that one first when we journalize it. So we write cash, move a little bit over. So we show that we're debiting cash for $2,200, skip a line, indent a little bit, and then we're going to credit revenue for $2,200. And now on the T accounts, we just copy over what we just did. We debit cash on the left side for $2,200, and we credit service revenue for $2,200 as well. So here we've journalized, and here we've posted to the ledger. Next one, we paid employees wages earned in January of $1,200. So we paid. So the key word there is paid, right? We paid employees $1,200 for wages earned. As long as they earn the wages, it's an expense to us, right? It's money that we have to pay to our employees, whether we owe them the cash right away or we get to pay them later. So there's a couple things happening here. We paid the wages. So if you pay wages, that must mean it involves cash. So cash, it must be going down by $1,200. At the same time, if you're paying wages, right, that means you incurred an expense. Okay? So that would be salaries / wages expense. And my expenses are going up now because now I incurred an extra expense. I had to pay money now for these wages. So a decrease to cash and an increase to wages expense. Cash is an asset, and decreases to assets are shown with a credit. Expenses, however, they decrease owner's equity / retained earnings. And how do you decrease owner's equity? You do that with a debit. Remember, expenses are always debits. So since the expense is the thing that I'm debiting, we want to list that first when we journalize it. So I'll debit salary or wages expense for $1,200, and then I skip a line, indent a little bit, and then I'm going to credit cash. Because remember, my expense is going up because I incurred salaries and wages that I have to pay. So that's a debit to expense of $1,200. And then I paid it with cash, so cash is going down, hence why I have to credit cash. I'm going to write those T accounts out. We have cash and salary expense. Cash is being credited, so it needs to be going on the left, but salaries expense is being debited, so that goes on the left here. Next one, paid for utilities used in January. So again, the key word there is paid, so that means immediately that's cash and not an accounts payable. You paid $200 for utilities. Utilities is something I have to pay for to keep the lights on, right? So to help me generate revenue, I can't not pay my utilities. So that would count as, or be regarded as, utilities expense. That's going up, right? Because I now incurred an extra expense. I got another bill. But I paid for it already, so I'm not going to increase accounts payable. Instead, I'm going to decrease cash in the amount of $200. Expenses are going up, so how do I record increases to expenses? Expenses are always debits, right? But cash is going down, and cash is an asset. How do I decrease assets? with a credit. And again, you list the debit first, right? So the expense is the one being debited. So we write utilities expense first. So we're going to debit that by doing it in the left-hand column. Debit utilities expense for $200. Then skip a line, indent a little bit, and write cash. And we're going to credit cash for $200 here. And then we want to, now that we've journalized that, we want to post that to the T accounts as well. We have cash, and we have utilities expense. Cash is being credited for $200. So remember we have this invisible T account here. So you can see cash is being credited on the right. And then utilities, you can see on the left it's being debited. All right, on to the next one here. They paid the Daily Tribune $360 cash for newspaper advertising to be run during February. So that's $360 if it's for an ad. It's an advertising expense. Okay, so we paid on February 1st for an ad to be run that same month. So it's not prepaid advertising, it's for that same period. So it's $360 of advertising expense, and how are we paying for it? In cash. So the advertising expense, that's going up, right? We just incurred an expense by paying for this ad, and we paid for it right away. So it's a decrease to cash instead of an increase to my liabilities, which would be in accounts payable. So since an advertising expense, that's going up, remember expenses are debits, and cash is going down, it's an asset. So I need to decrease that asset with a credit. Debits before credits, so I'm going to debit the advertising expense account first for $360. Then skip a line, indent a little bit, and I'm going to credit cash for $360 as well. Now I've journalized it, I can once again post it to the corresponding T accounts. So I have advertising expense and I have cash. I debited advertising expense here. Look at that invisible T account. So debit advertising expense on the left and credit cash on the right in its own T account. Okay, next one. Purchased radio advertising from KRAM to be aired in February. The cost was $470, payable within 30 days. So here we have an ad that's going to be run this month. So another ad expense of $470 this time, but this time we didn't pay for it right away, right? We don't have to pay for it for another month. So instead of cash being involved, that means accounts payable is involved, right? We owe money now. So your expenses are going up, while your liabilities are also going up, right? Accounts payable is also going up. You owe more money now. How do we increase expenses? We do that with a debit. How do we increase liabilities? With a credit. We do the debit first, and expenses are always debits anyways. Anytime you record an expense, it'll always be a debit. Debit advertising expense for $470, and I'm going to skip a line, indent a little bit, and credit accounts payable for $470 as well. Now I want to post that to my T accounts. I have advertising expense, and then I have accounts payable. Advertising expense is being debited, so I see that on the left here, left-hand column, and accounts payable is being credited on the right-hand side. All right. Let's see what the next one is. Purchased various shop supplies such as grease, solvents, nuts and bolts from Kappa Auto Parts. The cost was $1,400, due in 30 days. These supplies are expected to meet overnight needs for 3 or 4 months. Okay, so they're not using the supplies up necessarily right away. So we have shop supplies. So we're paying for these supplies ahead of time, so that's considered an asset. So $1,400 of supplies. And it says we didn't pay for it in cash, the amount is due in 30 days, so it's not cash, but it's accounts payable that's involved, right? When you owe money to someone else and they're not taking your money right away. So the shop supplies, that's an asset, that's going up by $1,400. That's going to last me for the next 4 months. And my accounts payable is also going up in the amount of $1,400 because I owe more money now. Shop supplies is an asset that's going up, so I show that with a debit. Accounts payable is a liability, and it's going up. But remember, liabilities are recorded, increases to liabilities are recorded with a credit. So now let's journalize. I'm going to debit shop supplies. List that first because it's the one being debited. Debit shop supplies for $1,400. I'm going to credit accounts payable for $1,400, just like I noted up at the top. Now we post to our T accounts. I have my shop supplies being debited, increased because it's an asset in the amount of $1,400. And then accounts payable is being credited in the amount of $1,400 since it's going up and it's a liability. All right, on to the next one here. All right, so this next one says we collected $4,980 cash for repairs made to vehicles of airport shuttle service. So we provided a service to the airport shuttle company because we provided repairs. So we collected cash, right? So we can see cash is going up, right? If you collected cash, that's an increase to cash of $4,980. And then what are you receiving the cash for? Well, you rendered a service. And what happens when you render a service? That means we earn revenue. So revenue is being earned, and revenue is going up in the amount of $4,980. Because why did you get the cash, right? That's the question we want to ask. What's the cash for? It's for revenue earned. So cash is going up, and it's an asset, so that needs to be increased with a debit. And remember, how do we record increases to revenues? That's with a credit, because it increases owner's equity, and owner's equity goes up with a credit. So debits before credits. So we're going to debit cash first. Skip a line, indent a little bit. And we're going to credit, probably we can be more specific and say, oops, that took away too much. Debit cash, $4,980. And then we'll say service revenue. We'll credit service revenue by indenting and putting the $4,980 credit on the right-hand side to show that it's being credited. And now we can post that to our T accounts. Cash is being debited and going up, so we do that on the left-hand side here. Service revenue is also going up, and we do that with a credit on the right-hand side. Next one. We billed Harbor Cab Company $5,400 for maintenance and repair. The agreement calls for payment to be received by March 10th, so they're not paying us right away. So we provided the service to build Harbor. We rendered a service. So whenever you render a service, that means that you've earned revenue, although you might not be paid right away. You've earned revenue. How much revenue did we earn? $5,400 worth. But we didn't receive cash. They're going to promise to pay us by March 10th. So what's the next best thing to cash when you don't get cash right away? That is accounts receivable. That means that refers to money that someone else owes me. So accounts receivable is going up, not cash, but accounts receivable, which is the promise of cash later. And they owe me $5,400 now. So revenue is going up, and we increase revenue with a credit. And accounts receivable is going up, and it's an asset, so we increase that with a debit. Debits before credit, so I'm going to debit accounts receivable first for $5,400. Then I'm going to credit my service revenue or my revenue account for $5,200. So you don't have to receive revenue in cash in order for it to be earned. As long as you've conducted and rendered the service or provided the goods or sold the goods, then you've earned revenue, although you might not be getting that cash right away. So that's why we use accounts receivable instead for these situations. We will post them to the T accounts. We have accounts receivable, and then we have revenue. Accounts receivable is being debited on the left, like we see there in the entry. Revenue is being credited on the right. So we're just, again, copying over into the T accounts what we're seeing here to the ledger. All right, and then paid. We paid employees' wages earned in February. And that is in the amount of $4,900. Okay, so they earned it in February and we paid it. So how do you pay it? If you pay wages, that has to be in cash. So cash is going down in the amount of $4,900. And if you're paying wages, right, what are you paying that cash for? That has to be wages expense that we refer to it as. And so that expense is going up. Wages expense, expenses are going up, and remember, expenses are always debits, so you do that with a debit. Cash is going down though, but it's an asset. Assets go down with a credit entry. So debits before credits, once again. So we are going to debit wages expense for $4,900 by doing it on the left here, and then we're going to skip a line, indent. We're going to credit cash for $4,900. Copy it once again over to our T accounts. Cash is being credited on the right-hand side, wages expense being debited on the left-hand side there. All right, next one. Let's take a look here. Recorded a $1,600 utility bill for February. The entire amount is due March 15th, so we're not paying that bill right away. So this is just recording a bill, a utility bill of $1,600. But if you receive the bill, you used up the service, right? So as long as I'm receiving a bill, I've incurred an expense. So this would refer to a utility expense in the amount of $1,600. But the entire amount isn't due until March 15th. I'm not paying cash just yet, so what do we do if we owe money? We record that then as an accounts payable. So utilities expense is going up by $1,600, but so is the accounts payable going up by $1,600. Remember, expenses go up with debits, and liabilities go up with credits. So let's go ahead and journalize this. We're going to debit utilities expense because we do that first, debits before credits, skip a line, indent, and then we're going to credit accounts payable for $1,600. And again, remember, after you journalize, next step is to post to the ledger accounts. And just copy over what you did here. And once again, I'll emphasize we have that invisible T account here, right? So really all that's happening is we're copying over what we see in that T account over here. So utilities expenses being debited on the left, accounts payable being credited on the right there. This thing will move. There we go. It looks like this might be our last transaction. It says Overnight Auto declares and pays a dividend of 40 cents per share to the owners of 8,000 shares of capital stock, a total of $3,200. So if they're paying 40 cents a share and there's 8,000 shares, that's where they're getting that $3,200. So that's how much dividends they're having to pay. So it says they declared and paid. So we'll get later in chapter 4, we'll get into the other situations, but here we declare and paid. So dividends are going up, right? It's not an expense. Dividends is something else. It is a payment to owners. So dividends are going up in the amount of $3,200. What do dividends do to retain earnings or to owner's equity overall? Remember we said it decreases it. So any decrease to owner's equity needs to be shown with a debit, just like an expense. And it says we declared and paid the dividend, right? So how do you pay things? You pay for things in cash. And since we're paying these dividends in cash, that's a decrease to cash in the amount of $3,200. And we decrease cash with a credit since it's an asset. So debits before credit. So I'm going to debit the dividends account. Debit it for $3,200. Skip a line, indent, and then I'm going to credit cash for $3,200 as well. Remember, revenues, expenses, and dividends all affect owner's equity, but they're not owner's equity accounts. Let me just remind you guys of that, because we didn't list them as part of owner's equity from the get-go, so just a reminder. So dividends being debited, so we're going to copy that over here, and cash being credited, so we're going to copy that over there. And now after we posted all of that to the T accounts, we should have ending balances in all of these, allowing us to set up a trial balance. So what a trial balance is, we can see, I don't think if I can draw on here, let's see, I think I might be able to, there we go. So with a trial balance, there's also this imaginary T account going on. We have the debit side and the credit side. So based on what the normal balance is in an account, its balance will be shown on the left or the right. Cash is an asset account, so it will have its balance on the left-hand side. And as long as I'm following the rules while I'm journalizing these things and posting them, all of the debits should be equal to all of my credits. So that's why it's called a trial balance. My debits need to equal my credits, and if they do, I most likely did everything correctly and I'm good to go. So we'll get more into the trial balance later on, but the main idea is that after you have a bunch of debits and credits to an account, you finally have a balance. You calculate its balance, and its balance will either be listed on the left-hand side or listed on the right-hand side. Now sometimes this can be a source of frustration because a trial balance, what if it doesn't balance? That's going to happen a lot in this class. Don't worry, it's part of the process. There are some limitations and some errors that can make it a little bit confusing. When it comes to locating errors, you always want to make sure that you maybe swap out a debit for a credit. Is there maybe a math error? Sometimes we transpose numbers, just putting a number in the wrong spot, or just journalizing something wrong or not journalizing something at all. So that's sometimes some sources of those errors in the trial balance. Okay, and a trial balance isn't the be-all and end-all of everything. Just because my debits equal my credits doesn't mean I did all of my work correctly. So just keep that in mind. You can have a bunch of entries missing and still balance if you did the other entries correctly, for example. Okay. And you might have switched debits and credits around without it being out of balance. So just keep in mind, just because a trial balance balances doesn't mean you're done. You always want to double check your work. And obviously we know computers improve efficiency, right? And the Connect program is another example of how it really improves our efficiency when it comes to recording this information. And you'll see that is especially true as we finish this chapter and go on to 4 and 5 as well. So it really just helps to make that process more efficient and effective. All right, so this video has gone on longer than I anticipated, but there was a lot to get through. Hopefully this is a video that you've been following along with. Pause it, rewind, make sure that you're understanding these debit and credit rules. So when we meet over Zoom, we'll be going over some example problems and working through these. So as always, compile a list of questions. Make sure that you know what you need help with, so we can get those questions answered in a timely and effective manner. So good luck with Chapter 3, and I'll talk to all of you guys soon.